Thanks for joining us at today's Magellan Update. I'm here with Hamish Douglass, the co-founder of Magellan Financial Group and the portfolio manager for the Magellan Global Equity Strategy. Hamish, you've spoken a lot about the United States in the past, and it appears as though that's going to plan. I'm more interested now, we're hearing a lot about China. Could you make some comments on that, please?
Well, thanks, Matt. I think China is a right focus at the moment. As you mentioned, the US really is going through a steady but sure economic recovery, very much what we're expecting. But China, we have changed our views somewhat in the recent past. We have been, I guess, somewhat of a China bull around the urbanisation story and the wealth effect of urbanisation in the country and the very long-term benefits and economic growth that China is going to go through. And we still believe in the long-term Chinese story, but we've turned quite bearish on China in the short to medium term. And that's quite a shift for us at Magellan. And we're asking ourselves a lot of questions around China. The question is, why would we be bearish on China if something it's almost turning into a sort of Anglo-Saxon groupthink thought turning bearish on China? There's a number of people who've been bearish on China for a very long period of time, and we haven't been, mainly because they don't run much external liabilities. We think the systemic risks in China to their system is relatively low, but that does not mean that China couldn't slow down materially or even go through a recession in the next few years. And what we're very focused is both on the credit side of the economy and, more importantly, the property side of the economy. If we start on the credit side of the economy, what has happened since 2008 has been unprecedented in history, in our view. The total credit outstanding in China has gone from around 75% of gross domestic product to over 200% of gross domestic product. That means the total credit outstanding is up nearly 2.5 times since 2008. The increase in credit in China in that period is equal to the total size of the US banking system. And the total credit outstanding in China is equal to the size of the next two largest banking systems in the world, Japan and the United States. So there's been a massive expansion in credit that's of course driven economic growth in China. Credit is still expanding in China at 30 percentage points of GDP. So the 200 is going to become 230, that will become 260, and so on if something doesn't change. And of course credit's been a very important driver of economic growth because it's what invests in property and infrastructure and fixed assets, is credit going into the system. But where China has got to at the moment is the interest bill on the credit is equal to about 30% of the economic output of China per annum. So we've seen a massive expansion in credit. The Chinese financial system is really the amalgamation of two component parts, which is making the credit more difficult to manage from a central government perspective. You've got the banking system, where nearly all the credit used to be, but it has rapidly expanded outside of the banking system into what is known as the shadow banking system. The shadow banking system has gone from 0 to 75% of GDP. So a huge portion of the total credit outstanding is now in the shadow banking system, and you can really split it down into three different components in China. You can look at money that has been lent to local governments, which is about half of the total. These are quite rubbery figures. We're going with the best information we've got, and there is no exact information in China, but directionally it's correct. So about half of the amount of the credit in the shadow banking system has been lent through trust companies, off-balance sheet entities, to local government authorities in order to invest in infrastructure and like airports and railways, etc. Some of this has been highly productive, some of it's highly unproductive. But the system has filtered money into that. But then outside of that, you've got the private side of the shadow banks. These are wealth management products where these banks have effectively said to their savers, we can offer you, instead of a regulated deposit rate, we can offer you a much higher interest rate, maybe 10 or 15% interest rate, and then this money is lent to people like property developers. And the property developers give some land or other property as security against these wealth management products. Sometimes it's a single asset vehicle. The only thing in supporting the value of the people put money on deposit in these products getting 15% interest rate, they're assuming that their money is safe. But if the asset supporting it is highly speculative property, if something was to go wrong, people could lose a lot of money in these wealth management products. And the last part is effectively corporations lending to other corporations. So effectively money being lent by individuals or corporations completely outside of the banking system. And who knows what the security is, and who knows what it's been lent to fund. So the system is getting much more difficult to control. The third part of China, which is the most important part, is what's actually happened in the property market. We really feel this is coming to a situation close to where we were in 2006 in America, where we have a massive amount of excess property supply in China, particularly in the residential part of the market. Prior to 2006, on our best information, and the information's rubbery, China was constructing slightly less than 1 billion square metres of residential property per year. Since 2006 and 7, the amount of development of new residential property has skyrocketed. Last year it was up over 2.5 billion square metres. So you've had an increase in development of residential property up 2.5 times per year to what it was running at pre sort of 2006, 2007. Our view is that China probably only needs 1 billion square metres of new residential property to keep up with the urbanisation of its population. The population urbanises at a rate around 20 million people a year. Last year it was 19 million people, and over the last decade it's averaged 21 million people per annum being urbanised. No more people are being urbanised today than was happening a decade ago. But since 2007, the amount of property being constructed is up by 2.5 times. This is quite a worrying statistic. Our view is over the last 5 years, China has built up an excess inventory of housing of 4 to 5 years of total supply. This is very similar to the ratio that we saw in America in 2006, 2007. Of course, this could go on for a period. They could keep constructing 2.5 billion square metres of property per annum when they only need to build 1 billion. Or they could go for another 5 years. Instead of being 5 billion square metres of excess, it could be 10 or 12 billion of excess. But eventually the music has to stop. Eventually, when there is an excess supply in the system, something has to give and supply-demand has to correct itself. The only way to correct this problem, in our view, is to either knock it all down that's been built, and maybe China can do that, but much of this property is in the hands of developers. We think 1 year's supply is now in the hands of developers in core cities, Tier 1 cities. In Tier 3 and 4 cities, it's reported property developers now have 2 years of inventory that they have to try and sell, and they're still building more. The rest of the excess inventory, maybe 3 or 4 years of supply, is actually sitting in investors' hands unrented. So vacant property sitting in the hands of investors. If you want to bring the market back into a supply-demand balance like happened in the United States, new property construction has to fall well below the average rate that is needed per annum to keep up with the urbanisation story. So it's going to have to fall well below 1 billion square metres a year. And they're building 2.5 billion square metres a year. So the new property development, in order to correct this problem, may have to fall by 50 to 75% a year. That is a much more dramatic fall in property construction than anybody is talking about. And when it happens, not if it happens, China will go through a material slowdown and most likely a recession when it happens. This is what happens in economies. What we can't tell you at Magellan is whether this will happen this year, next year, or in 5 years' time. It will very much depend upon what the regulators want to do. Of course, the regulators and the central government wants to keep growing their economy at 7% per annum. If they slow new property construction down materially, that's going to become an impossible objective. But also they realise all these risks building up in their financial system, which is going in to fund this construction. So our view in China is we are turning bearish on China. We don't know the timing, but we're feeling we're starting to get in an end play of this credit and property story in China. We're not saying there's going to be the Lehman Brothers systemic collapse of their financial system and banks are all going to get wiped out. We don't think that's going to happen because they don't run big external accounts and the central government can actually absorb a lot of losses. But we are saying the economy will slow down and it will possibly go into recession in the next, let's say, within a 3 to 5 year time frame. And if that happens, it will have obviously huge consequences for China-related investments. It will have a lot of consequences for nations that are dependent upon China as export markets, such as Australia, such as Brazil, Germany. It will have impacts on currency markets as well, and could well have impacts on the US Treasury market depending upon the scale of what's happening. We think there are enough warning signs out there that some of the canaries in the coal mine have started to go off. We have seen a depositors run in March on a small Chinese bank. We've seen a number of these wealth management products effectively default. The government's obviously allowed a few of the small ones to go to start bringing some moral hazard in here. But if we remember what happened in the United States in the subprime crisis, it got triggered in August 2006. The Lehman Brothers moment didn't happen until September 2008. We've seen a few of the very similar events that were happening in 2006. So maybe we're 2 years away from an event in China. Maybe we're 3 years away. We don't know, but we think there are enough signals going on and there is enough evidence of massive oversupply in China that you should be cautious as an investor for China-related investments, and you need to think about what other investments could get affected. We're not talking about a systemic crisis in the world, so this is very different to the situation in 2008 and 2009. But it is something you need to be focused on, that China is very unlikely to keep growing at 7% per annum.
Thanks, Hamish. I'd like you to move now, if you wouldn't mind, to the portfolio for a moment. We've seen fantastic absolute returns over the last year, but we've moderately underperformed the benchmark. Just wonder if you could comment on that performance for us briefly.
Well, thanks, Matt. I do think it's relevant, and I think we have to keep timeframes into perspective. We have moderately underperformed the benchmark, the world MSCI as it's known, in the last 12 months. The benchmark has delivered 33 or 34%, and we've delivered between 30 and 31% return. Are we concerned? Absolutely not at all. We are delighted with a 30% return in the strategy. We'd expect many of the investors would be very happy with this. We're very focused on the through the investment cycle return, which we have said to investors after fees we want to deliver a minimum over a 5 to 7 year period of a 9% return per annum. And of course last year, the last 12 months, it was a terrific contribution. But we inherently run a more defensive strategy than the market. We're running a lower volatility and lower risk and much higher quality strategy. So in a market that's up over 30% and we're up slightly less than the market, I would say to investors that's what you should expect Magellan to do. There are some very specific reasons of exactly what was the difference. Part of it's we're running lower risk. We had 1 or 2 investments that didn't have a great return, but they were relatively immaterial over the year. Tesco would be one of those investments over the last 12 months. It's actually the only investment that's had a negative contribution to return in the last 12 months. So we've had no investments that have actually had a hole, and we've actually been overweight the United States dollar. If you look at this slide, many of the major currencies in the world strengthened materially versus the Australian dollar in the last 12 months, particularly if you look at things like the euro, the British pound, the Swiss franc. Our portfolio, for various reasons, and partly we want to be defensive, it gives us a lot of protection, we are materially overweight the US dollar. The US dollar was weaker in the last 12 months relative to these other currencies. And because we're more overweighted, that actually took off some relative performance versus the benchmark. Does that concern us? No, we're holding it for a strategic reason. We want to protect people on the downside, and being overweight the US dollar, if we do get an adverse event out of China or we get an adverse event in the United States at the end of quantitative easing, being overweight the US dollar will actually be something I think our investors will be very pleased about. But over the last 12 months, when markets have been running, there are other currencies that are done better than the United States dollar. But overall, we're pretty pleased with the last 12 months' performance, and it's very much in line with our expectations of what our more defensive strategy should be doing in these very strong markets we've seen.
Thanks, Hamish. We do speak more around 3 to 5 to 7 year timeframes though. Would you mind reflecting a bit on longer term performance? I note the strategy approximately is up 23% per year over the last 3 years. Global world markets have done roughly 14% over that period of time. Can you talk to us a bit about that performance briefly?
Well, first of all, Matt, thank you very much for framing the question over three years. We really look over sort of 3 to 5 years in making investment decisions, and therefore the relevant judgment of how our decisions have gone is really in the context of a time frame of 3 to 5 years. Measuring things over 3 months or 6 months is largely irrelevant, and I would argue can be very dangerous and force investors to make wrong decisions. On this slide, we have put up what our total portfolio has done by stock as a contribution to our investment returns over the last 3 years. And you can see over a 3-year period, we have only had 3 stocks that have had a detraction to total returns, which I think is quite remarkable, and I think our investment analysts deserve a lot of credit. You know, there's a lot of decisions we have made over 3 years, and to have 3 investments, Diageo, Tesco and Sanofi, have been the only investments over that period that have had any negative contribution to return. I think the batting average of the investment team has been very solid. Of course, I can't guarantee in the future it will be as strong, and many investments we've made over these periods, and many of these have been framed around longer term investment calls, such as our investment in Lowe's, the home improvement retailer that we took about 3 years ago, has delivered an investment return double or triple what the market has delivered over that period of time. It has been a very, very solid contributor to return. Our big position in Google, Visa, eBay. You know, eBay had a very tough year last year. Its share price didn't go anywhere. But if you look over a 3-year period, it has substantially beaten the market over that period. So people could look at eBay last year and go, oh, it's not a great investment. Extend your time frame slightly in how you look at the world, and you see a very, very different picture. We remain incredibly positive around the eBay PayPal story, notwithstanding the share price paused last year after a very strong period of investment returns, and we look at over time, and we still remain of the view that eBay will continue over the next 3 to 5 years to deliver very satisfactory returns for the investors.
Thanks, Hamish. I'd like to move now to where valuations are at present generally. Whether you talk about markets, whether you talk about our portfolio, we've had really good runs. We've seen markets up some 60% since September 2011. And just wondering how you're seeing valuations at the moment.
Yeah, the markets as a whole, we think are pretty fairly priced at the moment. We don't think they're dramatic. There are pockets of material overvaluation. High growth tech would be an area where you've seen some ridiculous valuations out there. But certainly we're in markets that are much more fully to fairly priced. And that means compared to 18 months or so ago, our job's harder. it is much more difficult to find mispriced securities than when markets were 50% lower. I think that's a statement of the obvious. So we're not ringing the alarm bells. We see some risk out there around the end of quantitative easing. We see some risks out there, particularly around China. But we don't think markets are stupidly priced at the moment, but nor do we think there's a whole lot of bargains sitting out there in markets. You know, at the end of the day, as an active fund manager, our jobs become more difficult. There are fewer things that I'm finding which are easy to invest in. We're very comfortable with the overall portfolio, but the reserve bench isn't deep and rich as it may have been 3 years ago. I could have invested in lots of different things and got pretty good outcomes because markets were cheaper. We have to be very, very selective where we're moving at the moment. We're very comfortable with the portfolio we have, but we have fewer choices to move than we did some time ago. That's just a function of more fully valued markets at the moment. And it would say that the markets are probably, if there is an adverse correction in China or out of the United States with quantitative easing and markets are fully valued, it probably means they've further to fall as well at this point. And this is why we're very much looking at the defensive side of our portfolio to protect people on the downside.
Thanks, Hamish. I'd like to talk about one of those defensive names now. Tesco's a name that's been in the news a bit, detractor to performance. I just wonder where the investment thesis is now and how you're seeing things at Tesco.
Yeah, well, Tesco's been a challenging investment over the last 18 months. I don't think we should hide behind that. It has been our worst performer over the last 18 months. We're lucky we haven't had many of them, but Tesco's been a challenged investment story. We've actually been adding to the Tesco position in the recent months. And why would we be doing that? Tesco was hit by the perfect storm over the last 18 months. They had a Chinese and US business that was losing £700 million in cash a year. They had a business in the UK where their general merchandise part of their offering, particularly in electronics in their larger format stores, fell off a wall, and the profitability in that part of their business went from very profitable to unprofitable. They had Korea, a major business for them, where they banned trading on Sundays. They had some regulatory controls board in Malaysia, so almost everything that could have gone wrong did go wrong in Tesco. The good news today is they're out effectively of the United States and effectively out of China. That's £700 million a year they were losing that has now been fixed. Korea looks like it's been stabilised, and the rest of the Asian businesses looks like it's been stabilising, subject to some still unrest in Thailand, but the Asian businesses seem to be, now China's been dealt with much steadier. The European businesses have had a very tough run, and particularly their business in Turkey, which they still need to address, but we're confident the management team will find a solution for Turkey. It's probably losing between 50 and £100 million at the moment, their business in Turkey, but they will stop that bleed. So that's going to be a turnaround of maybe 750 million to 800 million pounds a year in cash flow. Two of them are fixed, one of them is work in progress. So most of the issues going outside of the UK have now been fixed, with a dramatic consequence for cash flow for investors. We now have to turn to the UK business. We believe, and our analysis indicates, that their fundamental convenience and food business is in a very good competitive position. Comps have been positive in that business. They have the largest convenience offering in the UK. On a relative position, they're sitting in the number 2 position in food. In our position, the performance of the food business, and it's been positive. In the last quarter, it was negative, but nearly everyone in the market was negative in the last quarter. But if you look over the 18 months to 2 years, their food business and their convenience business hasn't got a problem. What has got a problem is their large format extra stores, which is about 40% of their total real estate in the United States. A large portion of these stores were selling general merchandise like electronics, and the profitability completely fell off a cliff that resulted in a large profit downgrade a bit over 12 months ago in Tesco. They're now having to say they've got 40% of their total space in the UK, which has had a fundamental problem with the shift of general merchandise effectively to internet retailing and loss of the competitive position in store, which has led to a decrease in profitability in the UK. We believe management has got some outstanding plans for addressing those large format stores, and it's still very early days, and we've done a lot of work on this where they're wanting to take the old electronics and general merchandise space and put in some fantastic high margin concepts, restaurant concepts. They bought a restaurant chain, a family restaurant chain called Giraffe, much higher margin than the space that they're replacing. They've got a fabulous coffee concept, they've got a bakery concept, they've got a very, very good fashion concept. So they've got a whole series of concepts. They've done 3 stores last year. They're going to do 100 stores this year. Our view is the capital they're going to spend, the incremental returns are very, very high, and we believe in 3 years' time, when they've completed refurbishing their larger format stores in the UK, their business is going to look quite different. But they are a very good retailer. They're the number 1 retailer in the UK. They had a perfect storm in the last 18 months in their non-UK businesses. They're largely addressed. The UK business is still work in progress. There is no guarantees that this refurbishment of these large format stores, given the trends in consumer spending, is going to work. We think there's relatively limited downside risk. Tesco's on a 5% dividend yield, and on our numbers this year is on a 6% free cash flow yield. So free cash flow is supporting the dividend. We think there's very limited downside, and we actually think there's very substantial upside if they can fix the rest of the problems in Turkey, Asia stabilises, which we think it has, and if they can fix this large format store in the UK and put in some concepts that are productive into space that's become unproductive, we actually think we'll earn a very decent return on our Tesco investments. But it's not easy. This is a turnaround story. We invest in very, very few turnarounds. It's almost a unique type investment in our portfolio. At the moment, it's moderately sized. If we're right and if the management executes this plan well, we think we'll get decent returns. But don't expect any share price pop in the next 12 months. You know, this can be tough going for Tesco in the short term, but as I said earlier, we're not focused on short-term returns. We want to be measured over 3 to 5 years, and let's see if we're right on this one.
Thanks, Hamish.
A pleasure.
Thank you for watching. We trust you found this of interest. For more information, please visit our website.